Welcome to ZICA Academy YouTube channel. In this video, I will examine transfer price to achieve the residual income target using question from ICAN May 2024 Performance Management question number 5 as work example. If you are coming across my lecture for the first time, please like the video, share it with others and subscribe so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you for being part of this channel. What is transfer price? Transfer price is the price at which goods or services are transferred from one division to another within the same organization. The price at which goods and services are sold from one division to another within the same organization. That means transfer price is an internal price at which one division can sell goods or services to another division in the same organization. So that is transfer price. But in this video, my focus is on the determination of transfer price to achieve the targeted residual income. What do we mean by residual income? Residual income. I will advise you watch my earlier video on divisional performance. So I've explained all these concepts. Residual income is divisional profit less inputted interest. And to get the inputted or inputted cost is equal to cost of capital times divisional capital employed. Divisional capital employed. Depending on the word you are provided in the question, you may be given divisional investment. So if divisional investment is given, so that is what you are going to use as your capital employed. If net asset is given, you use your net asset as capital employed. And if it is total asset, you use your total asset as capital employed. And if it is total equity, you use your total equity as capital employed, depending on the information provided in the question. So now, if your divisional inputted interest can be calculated like this. No, if you want to prepare income statement. So you normally start with revenue. I will explain what I'm explaining all this concept and try to review my earlier presentation so that you'll be able to understand my teaching. Revenue less variable cost, that will give you contribution. Less fixed cost, that will give you profit. From the profit you have gotten, which is your divisional profit, you less inputted interest calculated on capital employed. It is then that you get your what? Your residual income. Anytime you have to calculate the price, either selling price or transfer price to achieve a targeted residual income, know that you are going to work back. So to work back, your transfer price is your price or transfer price is part of your revenue. No, revenue is the product of price and quantity. Price times quantity will give us revenue. So if revenue is price and times quantity, that means the price you want to determine is part of your revenue. Or the transfer price you want to determine is part of your revenue. All you need to do is to make your revenue the subject of the formula in this expression. So your revenue now will be equal to residual income, RI, residual income. If you bring this one with it, plus inputted interest, then if this one joins it, this might not become plus as well, plus fixed cost. If this one joins it as well, you have plus variable cost. So the format to calculate the transfer price where targeted residual income is given. So the format will appear just. So you start with residual income. Let me see, budgeted or targeted residual income. Budgeted residual income or targeted residual income So you now add imputed interest. You add imputed interest. I've told you that your imputed interest is your cost of capital. It will be given in the question times divisional capital employed. I've told you it may be given as capital employed, it may be given as net asset, it may be given as total asset. So depending on the information provided in the question. So you add your imputed interest. By the time you add your imputed interest, you get your divisional profit. Divisional profit. Then after divisional profit, so we have considered this and this. Then the next item is fixed cost. You add divisional fixed cost. Divisional fixed cost. By the time you add the divisional fixed cost, you arrive at divisional contribution. Divisional contribution. We have considered the fixed cost. Then we add the variable cost. You add divisional variable cost. Variable cost, which will be your production capacity times variable cost per unit. By the time you add that, you get divisional revenue. Divisional total revenue. The only difference, if you are calculating for the buying division, is that the variable cost will be divided into two. We are going to break down the variable cost into two for buying division. For buying division, the variable cost will be divided into two. The interdivisional transfer, which will be the product of, which will be the transfer price times transfer price times number of units transferred. So this will give you variable cost of interdivisional transfer. Then you may also have other variable costs. Others. So these are the two elements that will be given. And if you are not given the other variable cost, you might assume letter X for it. You can use a letter to denote that for the buying division. But if it is selling division, you only have one variable cost, which will be your production capacity times variable cost per unit given in the question. So you have divisional total revenue. Then you now subtract revenue from external sales. Revenue from external sales. If you subtract revenue from external sales, then you now get revenue from interdivisional transfer. Revenue from interdivisional transfer. So the revenue from external sales, those units sold externally, you have your quantity sold at external market times the market price of the products. That will give you the revenue from external sales. Then revenue from interdivisional transfer, you will now have the number of units transfer. Number of units transfer, you have it here. So to get your transfer price, you now divide the revenue from interdivisional transfer by the number of units transfer. You get the transfer price. Transfer price. Or it might be depending on the currency. So that is this divided by this will give you this. That is the transfer price. So this is the format for calculating the transfer price where you are given the targeted residual income. Keep watching. ICAN May 2024. Performance Management question number 5. Zona Tango ZT PLC is a holding company with 4 divisions, including urban and beta divisions. ABBA division produces a component that it sells externally and can also transfer to other divisions within the group. Beta division uses the components from ABBA division as a raw material for its final product. The division can also obtain the components from external suppliers. The components, when obtained from ABBA division, undergoes further processing at a cost of 4 naira 50 kobo per unit before it is sold to external market. The board of directors, in order to implement a new appraisal review, has set up a performance scheme for the divisional managers. A performance target for the next financial year has been set, and the following budgeted information relating to two divisions has been prepared. ABBA division and Beta division. Maximum productions or sales capacity, 900,000 units. Sales to external customers, 700,000 units. No constraints. Selling price, 6 naira 80 kobo. Variable unit cost, 4 naira 90 kobo. Divisional fixed cost, 160,000 and 140,000 naira for ABBA division and Beta division, respectively. Capital employed, 4 million naira and 3 million naira. Residual income, 700,000 naira and 500,000 naira. Divisional cost of capital, 12% and 10%. Beta division has asked ABBA division to quote a transfer price for units of the components required. A. Calculate the transfer price per unit, which ABBA division should quote to Beta division in order that its budgeted residual income target will be achieved. B. Calculate the selling price per unit, which Beta division should quote to external market in order that its budgeted residual income target will be achieved based on the transfer price quotation. State clearly your assumptions. C. Explain why the transfer price calculated in A may lead to suboptimal decision making from the point of view of ZTPLC, taken as a whole. D. In what circumstances will a negotiated transfer price be used instead of a market-based price? Now, let's have the solution to the question. Solution. The name of the entity is Zona Tango. Zona Tango ZT PLC. If you look at the requirement A, back to the question, you have to calculate the transfer price per unit, which ABBA division should quote to Beta division in order that its budgeted residual income target will be achieved. In order to achieve a residual income. Remember, we said residual income. We advise you go and watch my earlier presentation on calculation of residual income. So, if you want to prepare your profit statement, you start with sales, less variable costs, you get your contribution. Less fixed costs, you get the profit. From the profit you deduct the inputted cost or inputted interest. You get the residual income. So now your transfer price, since your sales revenue is price times quantity, the product of the two will give you the sales revenue. That means you make your sales revenue the subject of the formula. So your sales now will be equal to RI plus inputted cost or inputted interest. So then bring this one with it, plus FC, fixed cost, plus VC. So this will give you the sales. So now to calculate the transfer price calculation of transfer price to achieve the targeted or budgeted residual income for ABA division. So, if you look at this model, the first element there is residual income. So you start with the residual income. Now, let's go back to the question. How much is the residual income of the ABA division? We have the residual income of 700,000 naira. Residual income of ABA division is 700,000. After the residual income, the next element is inputted cost or inputted interest. So now let's add inputted interest. You'll be given the cost of capital. Go back to the question. So divisional cost of capital is 12%. If you calculate 12% of the capital employed, that will give you the inputted interest, inputted cost or inputted interest. So 12% of capital employed, which is 4 million naira. 12% of 4 million that gives us 480,000. That is the inputted interest. By the time you add the 480,000 and the 700,000, you add this 480,000 to the residual income. So you have 1,180,000. This 1,180,000 represents the divisional profit. So after we've considered this, the next element is fixed cost. We add the fixed cost. Fixed cost. Back to the question, how much is the fixed cost of ABA division? You have divisional fixed cost, 160,000 naira. So now let's add the 160,000 to that. So plus 160,000. So we have 1,340,000. This represents, profit plus fixed cost, that is contribution. So this represents divisional contribution. Then we've considered the fixed cost. The next element is variable cost. We add the variable cost also. So now let's add variable cost. Back to the question, how much is the variable cost incurred by ABA division? So you have variable cost, variable unit cost, 490 kobo. This is cost that change with the level of output. The output is 900,000. Output and sales is 900,000. So we have 900,000 times 4.9. So that will give us the total variable cost. 4 naira 90 kobo times 900,000. So we have 4 million for 10,000. If you add the 4 million for 10,000 to 1,340,000, then we have 5,750,000. So this is divisional revenue. This revenue comprises the revenue from external sales and revenue from interdivisional transfer. By the time you subtract the revenue from external sales that is external. How much is the revenue from external sales? Back to the question. You have sales to external customers, 700,000 units, and the selling price is 6.80 kobo. So by the time you multiply these 700,000 units by 6.80 kobo, you get the revenue from external sales. So we have 700,000 times 6.8. 700,000 times 6 naira 80 kobo. That gives us 4,760,000. That is the revenue from external sales. If you now subtract that from the total divisional revenue, let's subtract it from 5,750,000. So you will be left with 990,000. This is the revenue from interdivisional transfer. Revenue from interdivisional transfer. Now, how much will be the number of units transferred? Number of units transferred. Remember, the units produced, 900,000 units were produced, while out of which 700,000 units were sold to external customers. Then you'll be left with 200,000 units available for sales to the beta division. So 200,000, difference between 900,000 and 700,000. So number of units transferred now, which is 900,000 minus 700,000. So you'll be left with 200,000 units. So transfer price now. Transfer price will be 990,000 divided by 200,000 units. So we divide 990,000 by 200,000. So you'll be left with 4 naira 95 kobo. So this is the ideal transfer price. That is the transfer price to achieve the targeted residual income. That is the solution to the A part of the question. Now B, you are to calculate the selling price per unit, which beta division should quote to external market in order that its budgeted residual income target will be achieved based on the transfer price quotation. State clearly your assumptions. No, the quoted transfer price is 4 naira 95 kobo. So if these goods, 200,000 units, were transferred at this price, so what will not be the amount that beta division can sell the product and still achieve the targeted residual income of beta division? The targeted residual income of beta division is 500,000. What price should they quote for this product at external market to achieve this price? This is still a workback, just like A. Selling price. This is the solution to B. Calculation of selling price per unit. Calculation of the selling price per unit to achieve the budgeted residual income, that of beta limited, beta division. So you are also going to work back. Your selling price is still part of sales. I've told you that to make sales the solution formula, you have residual income plus inputted cost plus fixed cost plus variable cost. Now you are starting with the residual income. Now, budgeted residual income, that of of better division. Back to the question. How much is the residual income? We have residual income. That of better division is 500,000 naira. So we have 500,000. So we are going to add to this the imputed cost or imputed interest. Imputed interest. That is, if you apply cost of capital on capital employed. Back to the question. You are given divisional cost of capital. That of better division is 10%. And capital employed for better division is 3 million. So 10% of 3 million. 10% of 3 million. That will give us 300,000. If you add 300,000 to 500,000, then you have 800,000. This is divisional profit. Divisional profit. Then to this, we add, the next item is fixed cost. So you add divisional fixed cost. Divisional fixed cost. How much is that? So back to the question. Divisional fixed cost. That of better division amounted to 140,000 naira. So you add the 140,000 naira. 140,000 naira. By the time you add it to 800,000, you have 940,000. 940,000. This is divisional contribution. Then to this, you add variable cost. Variable cost. Remember, better division is the buying division. The buying division will incur two types of variable cost. Variable cost from interdivisional transfer and other variable costs. Variable cost, interdivisional transfer. Our assumption is that the number of units transferred will be 200,000. So we have 200,000 units times, remember the transfer price obtained from A is 4.95. So 200,000 times 4.95. That gives us 990,000. Aside the variable cost from interdivisional transfer, we have other variable costs. Other variable costs of the buying division. We're told the components, when obtained from other division, undergoes further processing at a cost of 4.50 kobo per unit before it is sold to external market. So other variable cost, 4.50 kobo. So that is the cost of converting it to finished product, 4.50 kobo. So 4.50 kobo times 200,000. 200,000 times 4.5. So we have 900,000. If you add the variable cost to your contribution, you have the total revenue of better division. So 900,000 plus 990,000 plus 940,000. 940,000. So we have 2,830,000. So number of units sold. So we have 200,000. Our assumptions here is that there is no loss in the process, no loss in production process. 1 unit of the components were used to achieve 1 unit of the finished product of better division. That is our major assumption here. So 2,830,000 divided by 200,000 So we have 14 naira 15 kobo. So selling price now per unit now, that will be 14 naira 15 kobo. That is the solution to the B part of the question. B. Explain why the transfer price calculated in A may lead to suboptimal decision making from the point of view of ZTPSC, taken as a whole. So the transfer price calculated in A was set to achieve the budgeted residual income, which will not to the benefit of the company as a whole. That transfer price, since it was set to achieve the targeted residual income, will not be to the benefit of the company as a whole. Since each divisional manager will strive to achieve its budgeted residual income without putting the interest of the company as a whole in mind. Therefore, the transfer price set to achieve the budgeted residual income will lead to suboptimality in the point of view of ZPSC. B. In what circumstances will a negotiated transfer price be used instead of a market-based price? I want to know that negotiated transfer price is the price at which both the selling division and the buying division agrees in advance to use a mutually acceptable transfer price. So negotiated transfer price is an ideal transfer price to use where an external intermediate market does not exist for the transferred product. Negotiated transfer price is an ideal method to use where an external intermediate market does not exist for the transferred product. So this marks the end of the solution to this question. Please make sure you drop the love emoji. Also, like the video, share it with others. Thanks for watching ZICA.